Welcome to the debate. Right now, somewhere in a major global enterprise, an automated financial system is processing 10,000 transactions a second. It is executing its programming perfectly.
Right, flawlessly.
Yeah, perfectly. And because it's doing it perfectly, it might just be triggering a massive compliance disaster. And the crazy part is, nobody in the building will even notice until it's way too late.
It is, honestly, the ultimate paradox of modern financial architecture. We build these incredibly fast machines to execute logic without a single error. But without the messy, human context surrounding that execution, flawless logic can lead to catastrophic systemic outcomes.
And that tension is exactly what we are tearing into today. We are looking at the permanent, structural restructuring of financial operations that's, currently underway. For decades, for its entire history, really, the finance function has been fundamentally a human engine.
Just armies of people.
Exactly. People reconciling ledgers, controllers managing close cycles, tax specialists validating data. But that era is ending. And the core question before us today is this. As we transition away from manual processes, where does the true existential risk to the organization actually hide?
It's a critical question, and it's one where our perspectives fundamentally diverge.
Right, because I argue that the ultimate risk is moving too slowly. Manual processes are, frankly, a structural liability. In an era of real-time digital compliance, human execution simply cannot physically scale to meet millisecond-level validation demands.
But
if you don't aggressively dismantle those manual bottlenecks, your operations will eventually just freeze.
Right, but I maintain that the far greater danger lies in the rush to automate itself. When organizations blindly swap out manual execution for software just to gain speed, they destroy vital, undocumented, tacit knowledge.
Okay, but
You end up with hollowed-out operations. You get automated systems that nobody in the business actually understands or even possesses the capability to govern.
well, let's start by defining exactly what we mean when we say manual work in this context. Because we aren't talking about, strategic forecasting or complex risk modeling. We are talking about the repetitive, rule-based processing of structured information at high volume.
Yeah, the daily grind.
Exactly. Think about manual reconciliation. You have a person staring at two screens or two massive spreadsheets, repeatedly applying matching logic to rows and rows of transaction records.
Right, it's highly repetitive. Nobody is arguing that it isn't mind-numbing work.
But more than being mind-numbing, it creates a hard physical limit on the business. It's a throughput ceiling. The human visual cortex and motor skills can only process so many rows per hour, right?
Sure.
You can only process as much data as your headcount allows. And historically, if you had a 1% error rate, which is actually quite good for human data entry,
Hell, very good, yeah.
that 1% used to just sit quietly in a ledger until someone found it during the month-end close.
It was a delayed problem. You had weeks to untangle the knot.
Exactly. But today, under regimes of continuous transaction controls, that grace period is gone. A manual process with 99% accuracy is no longer acceptable. And why? Because that 1% error rate instantly translates into a rejected invoice from a government server. It means a blocked payment. It means a truck physically cannot leave a warehouse because the tax authority hasn't cleared the shipment. Manual operations are not just inefficient anymore. They are an intolerable structural risk that must be systematically dismantled to match regulatory speed.
Look, I understand the appeal of that clean, mathematical view of automation. It looks fantastic on a whiteboard. But the reality of financial operations is far messier. There are massive hidden complexities inside what software vendors like to call rule-based work.
Give me an example, then. What's so complex about matching invoice A to purchase order B? The rules are the rules.
Well, let's look at intercompany matching, which is a classic target for automation. On paper, it's a simple rule. Entity X in Tokyo billed Entity Y in New York for $100,000, so Entity Y should show a payable for $100,000. Match them, clear it.
Right.
But in reality, there are always discrepancies. Always.
Sure. Currency fluctuations, maybe timing differences.
Exactly. Timing differences. Entity X in Tokyo books the invoice on Tuesday local time. Entity Y in New York logs it on Monday because of the time zone cutoff. Or maybe they're using asynchronous bank settlements that create like a 24-hour variance in the timestamp.
Okay, so the system flags it?
Right. The formal written rule programmed into the software says, these fields do not perfectly match, flag for critical error. But the human controller doing what we call the acceptable manual workaround knows exactly what that timing difference looks like.
Ah,
They know to ignore the 24-hour gap and manually force the match so the books can close.
okay. I follow the mechanics of the timing difference. But that just sounds like a broken process being held together by duct tape.
It is. It absolutely is. But that duct tape contains vital, undocumented, tacit knowledge. The controller has deep domain expertise about how the company's data actually flows across global time zones, even if the underlying systems are completely flawed.
I mean,
If you just view automation as replacing the execution, if you write a script that says match identical fields, the software will flag every single time zone variance as a critical error. You deploy a system that strips out that tacit knowledge and produces thousands of exceptions that nobody knows how to resolve.
wait. I'm stuck on this idea that the manual workaround is somehow valuable. You're almost describing the bad manual process as if it's protecting the company.
I'm sorry, but I just don't buy that. Let me tell you why. I actually refer to it as an immune system.
An immune system? Seriously? Walk me through how a bad process acts as an immune system.
Okay, think about how white blood cells work in the human body. A foreign body enters your bloodstream, the white blood cells recognize it based on past experience, and they neutralize it before you ever feel sick.
Okay.
In a massive finance department, legacy data architecture is constantly pumping out foreign bodies. Weird supplier codes, flawed tax fields generated by, I don't know, a customized ERP module from 10 years ago that nobody knows how to update.
Right, legacy junk.
Exactly. The human exception handler is the white blood cell. They see the bad data, recognize the historical quirk, and manually correct it before the filing goes to the tax authority. They neutralize the threat.
I see why you think that, but let me give you a different perspective. Relying on an immune system of manual human intervention in a modern regulatory environment is like using human toll booth operators on a highway where the cars are traveling at 500 miles per hour.
Okay, that's dramatic.
It's accurate. It doesn't just slow things down. The physical limitation of human processing speed fundamentally breaks the architecture of the entire system.
How does he break architecture if the human is catching the errors?
Because the human operates on human timescales. Let's look at the external pressures driving this because it explains the 500-mile-per-hour reality. We briefly mentioned continuous transaction controls earlier, but we really need to explain the mechanics of what regulators are actually demanding today.
Fair enough.
They do not want a PDF prepared by a human tax specialist at the end of the month anymore.
No, they want direct digital feeds.
Exactly. They want API calls. In countries running advanced digital tax models, when a pallet of goods is loaded onto a truck, the invoice data must be transmitted directly to the government server, validated against continuously updated tax rules and digitally approved with a timestamp in milliseconds, before that truck can legally leave the dock.
Right, the clearance model. It's intense.
Recognize the quirk, apply their tacit knowledge, and fix the field in the 3 milliseconds before the government server rejects it.
Well, obviously, they can't do it at the individual transaction level in real time.
Exactly. Which means what you're defending is entirely reactive. You're saying we need humans to constantly apply band-aids to flawed data outputs after the fact. But in real-time environments, the transaction is already rejected. What you're defending is a key person dependency that massively amplifies organizational risk. What happens when your white blood cell, tax specialist, is on vacation or resigns?
Well,
In a real-time environment, if you rely on human intervention to fix bad data, that tacit knowledge vanishes instantly. Your compliance fails unpredictably, and your supply chain literally, physically stops.
that's a compelling argument, but have you considered the governance vacuum that gets created when you try to engineer that human entirely out of the loop?
A governance vacuum?
Yes. Look, I completely acknowledge the speed imperative. I don't deny that tax authorities are demanding millisecond-level validation. But arguing that we must lead purely with technology to solve this speed issue is a massive, incredibly costly error.
But it's the only way to meet the physical requirement of the speed. How else do you process it milliseconds?
Yes, automation solves the speed problem. It allows you to process at 500 miles per hour. But if you don't first develop the capability of your existing human team to interpret the complex signals that the automated system is going to throw off, you are trading a throughput ceiling for a governance vacuum.
I need you to break down what you mean by a governance vacuum. If the system is explicitly designed and programmed to handle the rule-based execution, isn't it governing itself? I mean, it applies the defined logic infinitely faster and with far greater accuracy than a human ever could.
It executes logic. It doesn't govern.
What's the difference?
A machine can only execute the precise rules it was explicitly given. It cannot adapt to ambiguity. Let's go back to your 500-mile-per-hour toll booth analogy. Your analogy assumes every car is identical, the weather is perfect, and every single license plate is perfectly legible.
In a standardized corporate data environment, they should be perfectly legible.
But they aren't. Real-world enterprise data is incredibly messy. When you deploy an automated engine to handle real-time compliance, it will inevitably encounter edge cases. A new untested tax regulation in Brazil, for example.
Okay.
Or a major vendor in Germany suddenly changing their invoicing format without telling you. The automated system won't know what to do because it has no historical context. So it will spit out an exception.
Which is exactly what a well-designed system should do. It flags the anomaly for review.
But who reviews it? If you've systematically eliminated the manual processors because you thought they were just a bottleneck, you've fired the only people who understand the foundational data structures.
Oh, I see where you're going.
Right? You've lost the people who knew why the German vendor's code looked weird in the first place. The automated system flags the critical error at 500 miles per hour, and the remaining staff just stare at the screen because they have no idea how the underlying machinery actually works. They lack the analytical capability to detect when the automated outputs are wrong, and more importantly, the domain expertise to understand why they are wrong.
That's an interesting point, though I would frame it differently. You're suggesting we delay automation until we've perfectly mapped every nuance of human capability and exception handling.
Not delay forever, but
But if we take your cautious approach, aggressively protecting tacit knowledge and waiting until perfect capability is reached, we are accepting structural, non-compliant risk every single day.
I am not arguing for retaining manual processors indefinitely. I am arguing that the sequence of events matters fundamentally.
I agree, sequence matters, but the sequence of protecting manual processes is a dead end. I frame this transition as an elevation of the human role, not an elimination. And this is really where we have to look at the end game of this transition.
Okay, let's hear it.
Automation doesn't replace the human professional, it shifts them. The professional moves from being a data producer who manually keys in invoices to an intelligence interpreter. They evolve from a compliance manager just checking boxes to an architectural governor.
I love the theory of elevation. It's a beautiful concept on paper.
I'm not convinced by that line of reasoning, because you're treating it like a theoretical pipe dream. It's an operational reality for organizations doing this correctly.
Is it though?
Yes. Your pessimism assumes automation inherently diminishes the team's capabilities. In reality, if you automate the most exposed processes, specifically those dangerous key person dependencies, like the controller who has to manually tweak the spreadsheet every month.
The white blood cell.
Right. If you automate that, you actually free up human capacity. You can't govern the architecture if you're spending 60% of your week manually reconciling data. Automation forces the elevation to happen.
I come at it kind of different way. I look at how organizations actually behave under real-world financial pressure. When a CFO approves a multi-million-dollar automation transformation project, what is the immediate, instinctive organizational response once the software is plugged in?
Well, to measure the return on investment.
Exactly. And how do they practically measure that return? By reducing headcount. They look at the dashboard and say, we just automated intercompany reconciliation. Therefore, we need 5 fewer accountants.
Which is a short-sighted mistake, sure, but not an indictment of the technology itself.
It's an incredibly common mistake. If leadership treats technology simply as a cost-saving replacement for human execution, rather than an opportunity to reinvest in human capability, the elevation to intelligence interpreter never actually happens. You don't get elevated humans. You just get fewer people running faster machines.
Okay, let's explore that specific mechanic.
because I think it's critical to understand the risk you're pointing out. If a company takes the headcount savings, fires the manual processors, and doesn't reinvest in training, what specifically breaks? Why can't the remaining team members just step up into that governor role naturally once they have more time?
Because the skills required to be an architecture governor are fundamentally different from the skills required to be a data producer. Think about the cognitive profile we are dealing with here. You are asking a professional who has spent their entire career optimized for accuracy, completeness, and timeliness of manual reporting. Their brain is wired to ensure the individual numbers tie out perfectly at the end of the month.
Right, the classic detail-oriented accountant mindset.
Yes. And suddenly, overnight, you are asking them to pivot to pattern recognition, strategic synthesis, and algorithmic governance. You are asking them to look at a dashboard of 50,000 automated decisions made by a machine learning model and spot the one systemic bias in the algorithm that is slightly skewing the tax liabilities.
Wow. Yeah, that is a jump.
That kind of analytical leap doesn't happen just because you freed up 60% of their week. It requires a massive, deliberate, expensive investment in upskilling.
I completely agree that the upskilling is necessary, but the catalyst for that upskilling has to be the aggressive deployment of the technology. You cannot train someone to govern an intelligent system if the system doesn't exist yet.
But you can't just...
The organizations managing this well are doing both simultaneously. They are systematically identifying the specific activities that carry the highest risk, like those millisecond-level regulatory choke points we discussed, and they are automating those first.
I would argue they're usually automating the easy, repetitive stuff first and leaving the complex, high-risk, tacit knowledge completely unprotected.
But if they automate the choke points, they create the organizational capacity to train their workforce. They force the transition. A jurisdiction with real-time tax mandates does not offer a grace period while you send your accounting team to a boot camp on algorithmic governance.
Well, true.
When an invoice is rejected at the moment of transaction, the operational disruption is immediate. You cannot upskill your way out of a millisecond-level regulatory requirement using manual human processors. You have to put the architecture in place to handle the speed, and then train the humans to manage the architecture.
You have to put the architecture in place, yes. But you cannot build the tech and just hope the humans figure out how to govern it later. If you focus purely on eliminating the manual risk, you create the capability vacuum. You are replacing a highly visible human error rate, which, let's face it, we know how to manage with audits and reviews, with an invisible systemic failure rate. When the automated system runs into a wall at 500 miles per hour and nobody in the building understands the underlying data structures anymore because the experts were deemed redundant, the damage isn't localized. It's exponential.
I hear that. And I think we've circled around to a really fascinating point of convergence, even if we remain fiercely divided on the sequencing and what constitutes the primary threat.
I think we absolutely agree on the destination. The idea that human finance is somehow ending is just a myth.
Precisely. It's actually entering a much more demanding, highly strategic phase. The accountant isn't disappearing. Their role is fundamentally shifting away from manual data production. They have to become interpreters of incredibly complex systems.
Right. The human element isn't diminished at all. It is required at a much higher level of sophistication. We absolutely agree on that. But the tension between us remains focused on how leadership has to navigate the immediate transition. My stance is that the primary focus of leadership today must aggressively protect tacit knowledge. You have to map the cognitive process of your people and invest heavily in their capability to govern before these complex systems are fully unleashed. If you hollow out the expertise in the name of speed, you completely lose the ability to steer the machine.
And I summarize my stance by returning to the stark physical reality of the operating environment. Manual finance is ending because it is a structural liability. It is fundamentally incapable of meeting the millisecond speed and audit-ready evidence demands of a real-time regulatory world.
Yeah.
The failure to automate aggressively is the true existential threat, because the regulatory environment simply isn't waiting for organizations to feel comfortable with their upskilling programs.
It is an incredible balancing act. Designing human roles in an automated world requires acknowledging that human expertise, even in its messy, undocumented, duct-taped forms,
is what makes the automation valuable in the first place. You can't just pave over it and expect the software to know what to do.
It absolutely does require that balance. The architecture of financial operations is being rewritten from the ground up as we speak. We've really only scratched the surface of how intelligent systems can actually be governed, and there is so much more to explore regarding the specific mechanisms of this transition.
There really is.
We'll leave it to our listeners to weigh the risks and draw their own conclusions on the best path forward for their own operations. But as we sign off, I want to bring it back to that image we started with.
The flawless machine.
Exactly. The next time you see a dashboard showing thousands of transactions processing perfectly every single second, you have to ask yourself, are you looking at a perfectly governed operation, or are you just looking at a machine running blindly at 500 miles per hour, waiting for an exception it doesn't know how to handle?